The markets, to the uninitiated, appear as chaotic storms of unpredictable motion. Yet within this perceived chaos, a profound and elegant order exists, an intricate dance governed by immutable laws of price and time. For those willing to look beyond the surface, a hidden geometry reveals itself, offering a blueprint for understanding market behavior with astonishing precision. This geometry was meticulously charted by one of the most enigmatic and successful traders in financial history, William Delbert Gann, whose methods continue to captivate and challenge serious students of the market. His legacy is not merely a collection of indicators, but a comprehensive philosophy, a testament to the idea that financial markets are not random, but rather reflections of natural law, symmetry, and proportion. He sought to unlock the very rhythm of the universe as it manifested in the ebb and flow of capital, believing that every move, every turn, every significant shift was predetermined by underlying mathematical relationships. The pursuit of this ultimate market knowledge led him to develop a system so intricate, yet so fundamentally simple in its core principles, that it remains a subject of intense study and reverence. Today we delve into one of the cornerstones of his revolutionary approach, the W.D. Gann one-by-one angle rule, a concept that encapsulates the perfect timing and balance between price movement and the passage of time, serving as a beacon for those seeking clarity amidst market uncertainty. It is more than just a line on a chart. It is a profound statement about the equilibrium of market forces, a visual representation of when price and time are moving in perfect harmony, a state that, when understood, unlocks unparalleled insights into future market direction and potential turning points. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. William Delbert Gann stands as a towering, almost mythical figure in the annals of financial history, a name whispered with a mixture of awe and intrigue among serious traders and analysts. Born in 1878, his journey was not one of conventional academic pursuit, but rather an intensely self-directed exploration into the deeper mechanics of the universe, which he believed held the keys to market forecasting. His early life was marked by humble beginnings, yet his intellectual curiosity was boundless. He delved into ancient mathematics, geometry, astronomy, and even biblical studies, seeking universal laws that could explain the cyclical nature of existence. Gann's profound insights were not born from abstract theories alone. They were forged through decades of relentless market observation, meticulous chart work, and real-world trading experience. He famously claimed to have made millions from the markets, a feat that, whether fully verifiable or not, solidified his legendary status. His methods were often shrouded in an almost mystical aura, making them seem inaccessible to many. Yet at their core lay a logical, mathematical framework. Gann's central idea, the very bedrock of his entire methodology, was that markets are not random. Instead, he posited that they are governed by natural laws, cycles, and mathematical ratios, much like the celestial bodies or the seasons. For Gann, every price movement, every market reversal, every period of consolidation was part of a larger, predictable pattern. He firmly believed that the past repeats because human nature, driven by fear and greed, remains constant, and these fundamental emotions express themselves in recurring mathematical and geometric patterns. This perspective was revolutionary, challenging the prevailing notion of markets as purely driven by news or fundamental events. He saw price and time not as separate entities, but as inseparable components of a single, unified market dynamic. To truly understand a market, one had to analyze its movement through both dimensions simultaneously, recognizing that time itself was as crucial a factor as price in determining future direction. This holistic view of market action, where price and time are inextricably linked, is what sets Gann's work apart and forms the foundation for his sophisticated analytical tools, including his renowned angles. He understood that a market's true health and potential direction could only be assessed by observing how its price moved over specific units of time, seeking out the harmonious, often geometric relationships between these two fundamental forces. The general concept of Gann angles emerges from this profound understanding of market dynamics, representing a system of diagonal lines drawn from significant price points on a chart. These aren't arbitrary lines. They are geometrically precise constructions designed to reveal the underlying structure and potential future path of a market. The primary objective of utilizing Gann angles is multifaceted: to identify critical levels of support and resistance, to gauge the strength and velocity of a prevailing trend, and most importantly, to anticipate potential points of trend change or acceleration. Unlike horizontal support and resistance lines, which only consider price, Gann angles incorporate the crucial element of time, making them dynamic rather than static. They continuously adjust with the market's progression, offering a real-time assessment of its trajectory. The fundamental principle underpinning all Gann angles is elegantly simple yet profoundly powerful. Price and time move in proportion. This means that for a market to maintain a certain trend, its price must advance or decline by a specific amount over a corresponding unit of time. When this proportional relationship is maintained, the market is said to be moving on angle, indicating a balanced and sustainable trend. When the price deviates significantly from an angle, it signals an imbalance, suggesting either an acceleration of the current trend or, more often, an impending reversal. Gann developed a series of these angles, each representing a different ratio of price to time, such as 1 times 2, 1 times 4, 2 times 1, 4 times 1, and so forth. Each angle signifies a different rate of ascent or descent, providing a spectrum of potential trend strengths. However, amidst this intricate web of diagonal lines, one angle holds paramount importance, serving as the very linchpin of his entire system: the 1-by-1 angle. It is considered the most critical because it represents the perfect equilibrium, the ideal balance point from which all other angles derive their significance. Understanding the general concept of these angles is the first step towards appreciating the genius of Gann, but truly mastering his approach requires a deep dive into the specific dynamics of the 1-by-1 angle, which acts as the compass for market direction. The rule of the 1-by-1 angle stands as the undisputed cornerstone of William Delbert Gann's entire analytical framework, a concept he considered to be the most vital and fundamental of all his market tools. Its definition is disarmingly simple, yet its implications are profound. The 1-by-1 angle is established when 1 unit of price corresponds precisely to 1 unit of time. This seemingly straightforward ratio embodies a deep philosophical principle about market behavior. Its significance cannot be overstated. Gann himself emphasized that this particular angle represents the ultimate balance, the perfect equilibrium between the two most critical dimensions of market movement: price and time. It is not just another line on a chart. It is a symbolic representation of an ideal state, where market forces are perfectly aligned, moving with a harmonious rhythm. When a market adheres to its 1-by-1 angle, it suggests a sustainable, balanced trend, where neither price nor time is dominating the other, but rather progressing in a synchronized fashion. This angle, therefore, acts as a barometer of market health and stability. The method of its construction is critical to its correct application. A 1-by-1 angle is always drawn from a significant, clearly identifiable high or low point on the chart. These pivot points, whether major tops or bottoms, serve as the origin from which the angle extends into the future, acting as a dynamic projection of future support or resistance. From a significant low, a 1-by-1 angle slopes upwards, indicating bullish support. From a significant high, it slopes downwards, indicating bearish resistance. The interpretation of a market's interaction with its 1-by-1 angle provides immediate and powerful insights into its underlying trend. If the price remains consistently above an ascending 1-by-1 angle, it is a strong indicator of a persistent bullish trend. This suggests that buyers are in control, and the market is advancing at a steady, sustainable pace. Conversely, if the price consistently trades below a descending 1-by-1 angle, It signals a dominant bearish trend, indicating that sellers are maintaining control and the market is declining at a balanced rate. The most critical interpretation, however, arises when the price intersects or breaks the 1x1 angle. A decisive break above a descending 1x1 angle or below an ascending 1x1 angle is interpreted as a potent signal for a potential change in trend direction. Such an intersection is not to be taken lightly. It often precedes a significant shift in market sentiment and momentum. Moreover, a break can also signify a substantial acceleration in the existing trend if the market moves away from the angle with increased velocity, indicating that the previous equilibrium has been disrupted. The 1x1 angle, therefore, serves as a dynamic pivot point, a critical line in the sand that, once crossed, demands attention and often heralds a new phase in the market's journey. Its simplicity belies its profound analytical power, making it an indispensable tool for any serious student of Gann's methodology. The geometric principles underpinning the 1x1 angle are not merely coincidental. They are fundamental to its power and efficacy. At its core, the 1x1 angle on a correctly scaled chart corresponds precisely to a 45-degree angle. This is not an arbitrary assignment, but a deliberate connection to universal geometric truths. In geometry, a 45-degree angle represents a perfect balance, a state of equilibrium between two axes. When applied to market analysis, these two axes are price and time. A 45-degree angle perfectly bisects the quadrant formed by the price and time scales, signifying that price is moving at an equal rate to time. This visual representation of equilibrium is crucial. However, the integrity and accuracy of this geometric relationship are entirely dependent on the correct scaling of the chart. This is a point that Gann himself emphasized with utmost rigor, and it is arguably the most critical aspect of applying his angles. For the 1x1 angle to truly represent 1 unit of price for 1 unit of time, the chart must be scaled so that 1 unit of price on the vertical axis occupies the same physical space as 1 unit of time on the horizontal axis. Without this precise scaling, the 45-degree angle loses its significance, and the geometric relationships become distorted, rendering the angles unreliable. For instance, if 1 unit of price is represented by a much smaller distance than 1 unit of time on the chart, the 1x1 angle will appear much flatter than 45 degrees, falsely indicating a slow trend. Conversely, if 1 unit of price occupies a much larger space, the angle will appear steeper, falsely suggesting a rapid trend. This necessity for correct scaling often presents a challenge for modern traders using digital charting platforms, as automatic scaling can obscure these vital geometric proportions. Gann often used square root calculations or specific price per bar ratios to ensure his charts maintained this crucial square formation, where each unit of price and time formed a perfect square. This meticulous attention to scaling connects the 1x1 angle directly to the broader concept of natural laws and universal harmony. Gann believed that markets, like all natural phenomena, are governed by underlying mathematical order. The 45-degree angle, representing perfect symmetry and balance, is a ubiquitous symbol in nature, art, and ancient sciences. It appears in the construction of pyramids, the patterns of plant growth, and the orbits of celestial bodies. By correlating market movements to this fundamental geometric form, Gann was essentially arguing that markets are not isolated man-made constructs, but rather reflections of these deeper universal principles of symmetry, balance, and cyclicity. The 1x1 angle, therefore, is more than just a technical indicator. It is a profound philosophical statement about the inherent order within financial systems, a bridge between the seemingly chaotic world of trading and the timeless elegance of natural law. Its geometric foundation provides a robust and logical basis for its interpretative power, offering a visual pathway to understanding the market's true rhythm. The practical application and interpretation of the 1x1 angle offer traders a powerful lens through which to analyze market dynamics and make informed decisions. For traders who integrate Gann's methods, the 1x1 angle is primarily utilized to define the strength of an existing trend and to identify potential levels of dynamic support and resistance. It provides a real-time visual representation of the market's trajectory, helping to differentiate between strong, balanced trends and those that are losing momentum or poised for a reversal. When a market consistently moves along the one-by-one angle, it is a highly significant observation. This indicates a strong, balanced, and sustainable trend. For an ascending one-by-one angle, this means the price is advancing steadily, often bouncing off the angle as support during pullbacks, confirming the bullish momentum. For a descending one-by-one angle, it implies a controlled and persistent decline, with the angle acting as resistance during rallies. Such movements signify that the market is in a state of equilibrium, where buying and selling pressures are balanced at a specific rate of change, allowing the trend to continue without significant disruption. Traders often use this observation to confirm their positions, holding on to trades as long as the price respects the angle, or initiating new trades in the direction of the trend with greater confidence. However, the most critical signal generated by the one-by-one angle is a breakout or breakdown. A decisive penetration of the one-by-one angle, either above a descending angle or below an ascending one, is a potent warning signal. It suggests that the previous balance between price and time has been disrupted, and the market is undergoing a significant shift in its underlying dynamics. This break is not merely a minor fluctuation. It often indicates the potential for a substantial acceleration in a new direction. For instance, if a market has been trending downwards respecting a descending one-by-one angle and then decisively breaks above it, this could signal the beginning of a new bullish trend or a significant rally. Conversely, a break below an ascending one-by-one angle suggests a potential shift from a bullish to a bearish phase. Such a break often triggers a cascade of orders as traders recognize the shift in momentum. The one-by-one angle can also be thought of as a center of gravity for the market. Just as a pendulum swings around its central equilibrium point, the market tends to gravitate towards and interact with its one-by-one angle. Price action that moves too far away from the one-by-one angle, either too steeply or too flatly, often signals an unsustainable movement that will eventually correct back towards or even beyond the one-by-one. This concept implies that when a market becomes too extended in one direction relative to its balanced time progression, it is ripe for a reversal or a significant consolidation to restore equilibrium. Therefore, the one-by-one angle serves as a constant reference point, a dynamic mean reversion level around which the market oscillates. Its practical value lies in its ability to provide clear, actionable signals for trend confirmation, potential reversals, and the overall health of market momentum, making it an indispensable tool for astute market observers. To apply these strategic rules with a master's precision, you must learn to read beyond the chart and grasp the dynamics behind every movement. William Delbert Gann's Truth of the Stock Tape is the foundational guide for this skill. It's not a book of theory. It's a practical course that teaches you to understand the real-time contest between buyers and sellers, recognize the critical phases of accumulation and distribution, and assess a trend's true strength. This edition is a faithful reproduction of the 1923 original. The historical charts from that 100-year-old publication are included. While many are difficult to read, their inclusion was deemed important for historical context. The true timeless value, however, lies in Gann's text. For any serious student ready to understand the market's real intent, this book is an essential resource. The link is in the description. While the one-by-one angle is undoubtedly a powerful and foundational tool within William Delbert Gann's methodology, it is crucial to understand its limitations and nuances, as Gann himself would have emphasized. His system was comprehensive and multifaceted, and no single tool, not even the revered one-by-one angle, was ever intended to be a standalone predictive instrument. Gann consistently taught that the angles, including the one-by-one, must be used in conjunction with his other advanced methods. These include his various squaring techniques, such as squaring price with time, squaring the range, and squaring the circle, as well as his intricate understanding of market cycles, astrological influences, and numerical progressions. To isolate the one-by-one angle and use it in isolation would be to miss the profound synergy that exists between all components of his system. Each element was designed to complement and validate the others, creating a robust framework that offered multiple confirmations for potential market turns and trend continuations. A signal from a one-by-one angle, for instance, would gain significantly more credibility if it coincided with a key cycle turn or a specific price-time square. Furthermore, the effective application of Gann's methods, particularly the one-by-one angle, demands a significant level of skill, dedication, and practical experience. This is not a plug-and-play indicator that can be mastered overnight. The most challenging aspect, as previously discussed, is the correct scaling of charts. Identifying significant swing highs and lows from which to draw the angles also requires a discerning eye and a deep understanding of market structure. What constitutes a significant pivot point can sometimes be subjective, and the choice of starting point can drastically alter the trajectory of the angle and consequently its interpretation. This highlights the inherent subjectivity in its application. Different traders, even those well-versed in Gann's work, might identify different starting points or apply slightly different scaling ratios, leading to variations in their analysis. This is not a flaw in the method itself, but rather a testament to the fact that Gann's work is more an art form, refined through practice and intuition, than a rigid scientific formula. Moreover, the one-by-one angle, like all of Gann's tools, is primarily an instrument of analysis and not an absolute, infallible predictive system. It helps to understand the current state of the market, gauge its momentum, and identify high-probability areas for support, resistance, and trend changes. It provides a framework for anticipating potential future movements, but it does not guarantee them. Market outcomes are influenced by a myriad of factors, and even the most elegant geometric analysis can be overridden by unforeseen events or extreme shifts in sentiment. The true value of the one-by-one angle lies in its ability to offer probabilities and to provide a structured approach to market observation rather than promising certainties. It acts as a guide, helping traders to align their decisions with the underlying forces of price and time. But it still requires the trader's judgment, risk management, and adaptability. Understanding these limitations is not a detraction from Gann's genius, but an essential part of appreciating the depth and complexity of his work, reinforcing the idea that mastery in trading is a continuous journey of learning and refinement. In conclusion, the W.D. Gann one-by-one angle rule stands as a profound and enduring cornerstone of William Delbert Gann's revolutionary methodology, a testament to his unparalleled insights into the hidden order of financial markets. We have explored its definition as the perfect balance where one unit of price moves in harmony with one unit of time, establishing it as the most fundamental and critical angle within his extensive system. Its geometric basis, corresponding to a 45-degree angle on a properly scaled chart, underscores its connection to universal principles of symmetry and equilibrium, echoing natural laws that govern all forms of movement and growth. This angle is not merely a line, it is a dynamic indicator of market health, providing invaluable insights into trend strength, potential support and resistance levels, and, most importantly, signaling critical junctures where the market's trajectory may shift. The concept of perfect timing, so central to Gann's philosophy, finds its clearest expression in the one-by-one angle. When a market adheres to this angle, it moves with a balanced rhythm, allowing for sustainable trends. When it breaks free, it signals a disruption of this equilibrium, often preceding significant accelerations or reversals. While its power is undeniable, it is vital to remember that the one-by-one angle, in Gann's view, was never a standalone tool. It was designed to be integrated with his broader framework of squaring techniques, cycles, and numerical relationships, forming a holistic approach to market analysis. Its effective application demands dedication, meticulous chart work, and a deep understanding of market structure, emphasizing that mastery is a journey, not a destination. For those who are willing to commit to this journey, to delve deeper into the intricate principles laid out by Gann, the one-by-one angle offers a compelling starting point. It serves as an invitation to explore a world where market behavior is not random but governed by predictable patterns, where geometry and time converge to reveal the underlying pulse of financial instruments. The legacy of William Delbert Gann continues to offer profound knowledge, challenging conventional wisdom and providing a unique, geometrically informed perspective on market timing and behavior. His work remains a beacon for serious students, guiding them towards a deeper comprehension of the market's true intent through the elegant and timeless prism of geometry and time. The insights gleaned from mastering the one-by-one angle are but a doorway into a larger universe of market understanding, promising a level of clarity and foresight that transcends mere technical analysis, allowing one to perceive the market's rhythm with unprecedented precision. It invites traders to think beyond the immediate fluctuations and to grasp the grand design, the underlying blueprint that orchestrates every market move, ultimately empowering them to navigate the complexities of trading with greater wisdom and confidence.